Welcome to this comprehensive guide on maximizing your tax-advantaged wealth, especially if you are preparing for a major career transition such as long-term military service. In this video, we will walk through a practical blueprint that prioritizes immediate returns and long-term growth by sequencing benefits like the employer 401k match, health savings accounts, and Roth IRAs. We will include timelines, diagrams, and actionable steps you can take before tax deadlines. Let us begin by outlining what we will cover. Here is the roadmap. First, we will explain why this topic matters right now. Next, we will dive deep into the HSA Triple Tax Advantage. Then, we will cover prior year contribution rules and key deadlines. After that, we will highlight the Dependency Tax Trap. We will continue with why the 401k match is foundational, and then lay out the optimal sequencing blueprint. We will compare account features, provide an action checklist, and close with quizzes and key takeaways. Before a major career change, it is critical to optimize benefits that provide guaranteed returns and tax advantages. For many, this window is the last chance to capture employer contributions and make tax-advantaged moves for the prior year before filing. Therefore, locking in free money from employer matching and the triple tax advantages of an HSA can materially accelerate long-term wealth. With deadlines approaching, the timing of your actions matters. Disclaimer: this video is for educational purposes only and is not tax, investment, or legal advice. Rules can change, and eligibility varies. Always verify current IRS contribution limits, HSA eligibility criteria, and employer plan rules. Consider consulting a fiduciary advisor or tax professional to tailor this information to your specific circumstances. Let us unpack why the HSA is widely considered the most powerful savings vehicle for long-term investors. First, contributions are tax-deductible, meaning they reduce taxable income in the year contributed. Second, growth inside the HSA is tax-free, including interest, dividends, and capital gains. Third, withdrawals used for qualified medical expenses are also tax-free. For younger investors with long time horizons, these three layers of tax advantages compound to create a highly efficient retirement health and wealth funding tool. For strategy, many people invest HSA funds after meeting the cash minimum required by their HSA provider. Additionally, saving and organizing medical receipts allows you to reimburse yourself in the future for past expenses, effectively creating a flexible, tax-free distribution. Finally, remember that HSA eligibility requires enrollment in a qualifying high-deductible health plan, having no disqualifying coverage, and not being claimed as a dependent on another person's tax return. Here are the steps to maximize your HSA before the filing deadline. First, check the IRS limit for your tax year, including any catch-up contributions if you qualify, and confirm whether you are on self-only or family coverage. Second, verify that prior year contributions are allowed until the tax filing deadline, which is often around April 15th, but confirm the exact date for your situation. Third, calculate how much contribution room you have left and set up either payroll deductions or a direct transfer to hit the limit. Fourth, once your cash threshold is met, invest according to your plan's options and your risk tolerance. Finally, keep your medical receipts organized for potential future reimbursements and maintain documentation in case of IRS inquiries. A critical eligibility factor for HSAs is dependency status. If another individual claims you as a dependent on their tax return, you generally cannot contribute to an HSA, even if you are covered by a qualifying high-deductible health plan. This is a common point of confusion for students, adult children on parents' plans, or those in unique family arrangements. To avoid penalties and corrective distributions, confirm your filing status before contributing. When uncertain, consult your employer's HR team or a qualified tax professional. Employer matching contributions are effectively free money and represent a guaranteed, immediate return on your savings. For example, if your employer matches 100% up to 6% of your salary, contributing at least 6% earns a 100% return on that portion instantly. Even partial matches significantly improve your compounding over time. Therefore, adjust your deferral rate to ensure you receive the full match every pay period. This is a foundational building block before moving to other savings vehicles. Here is the recommended sequence for maximum impact. First, capture your full employer 401k match because it is guaranteed and immediate. Second, maximize your HSA to harness the triple tax advantage. Third, Fund a Roth IRA to further build tax-free growth and retirement flexibility. Fourth, if your budget allows, increase your 401k contributions beyond the matched amount to accelerate tax-deferred savings. Fifth, maintain or build an adequate cash buffer to handle short-term needs and reduce the risk of tapping long-term investments during volatility. This table compares key attributes of 3 primary accounts. For HSAs, contributions are typically pre-tax or deductible, growth is tax-free, and qualified medical withdrawals are tax-free. HSAs require HDHP coverage and that you are not claimed as a dependent. Roth IRAs are funded with after-tax dollars, grow tax-free, and qualified withdrawals are tax-free, though income phase-outs and contribution limits may apply. 401k plans can be traditional or Roth. Traditional contributions are pre-tax with tax-deferred growth, while Roth 401k contributions are after-tax with tax-free growth and qualified withdrawals. Each plan has different access features, rules, and potential employer involvement such as matching and vesting. Before your transition, take these concrete steps. First, ensure your 401k deferral rate is high enough to capture the full employer match for each paycheck. Second, confirm your HSA eligibility and compute any remaining room for prior year contributions. Third, automate contributions to both the HSA and Roth IRA to avoid missing deadlines. Fourth, review your employer plan documents, including any vesting schedules for employer contributions. Fifth, organize medical receipts, contribution confirmations, and keep a record of IRS limits and your totals for accurate reporting. Quiz time. The question is, which 3 tax benefits make the HSA uniquely powerful for long-term saving? Option A, deductible contributions, tax-free growth, tax-free qualified withdrawals. Option B, deductible contributions, taxable growth, tax-free withdrawals. Option C, after-tax contributions, tax-free growth, taxable withdrawals. Option D, deductible contributions, tax-deferred growth, taxable withdrawals at retirement. You may pause the video now to consider your answer. We will discuss the correct answer in the next section. The correct answer is A. HSAs offer deductible contributions, tax-free growth, and tax-free withdrawals for qualified medical expenses. This combination is often referred to as the triple tax advantage, making HSAs uniquely attractive for long-term savers. Next question, true or false? If you are claimed as a dependent on someone else's tax return, you can still contribute to an HSA if you are on a high deductible health plan. Option A, true. Option B, false. You may pause the video now to think about your answer. We will confirm the correct answer in the following section. The correct answer is B, false. If you are claimed as a dependent on another person's tax return, you are generally not eligible to make HSA contributions, even if you have HDHP coverage. Always confirm your status to avoid errors and penalties. As you build your personal plan, consider keeping concise notes. Use bold text to highlight the most important actions, such as prioritizing the 401k match. Maintain a simple list of upcoming deadlines, including the HSA prior year contribution check, payroll updates, and Roth IRA automation. A small checklist helps ensure you verify HSA eligibility, calculate remaining contribution room, and confirm your employer match percentage. Here are the essential points to remember. First, always capture the employer 401k match because it is free money and a guaranteed return. Second, maximize your HSA to benefit from the triple tax advantage. Third, fund a Roth IRA to continue building tax-free growth and flexibility. Fourth, leverage filing deadlines, especially the HSA prior year window, to fill in any remaining contribution room. Finally, verify HSA eligibility, particularly your dependency status, to avoid disallowed contributions. To wrap up, follow the sequence of capturing your 401k match first, maximizing your HSA second, and funding your Roth IRA third. Use a clear timeline to make any eligible prior year HSA contributions before the filing deadline. Confirm your dependency status to ensure eligibility. Automate contributions to stay on track, and maintain organized records for accuracy and peace of mind. Thank you for watching. If this blueprint helped you, please like the video, share it with someone who can benefit, and subscribe for more practical, research-backed money strategies. Post your questions and your personal 1, 2, 3 sequence in the comments so we can learn together.